Thank you, everyone, and welcome to TMG Tonight. I'm Carmen Villarma, president of the TMG family of companies. We are a full-service real estate company offering property management, HOA management, maintenance, and home sales. Our goal with TMG Tonight is to deliver information that will make us better investors, better board members, and better caretakers of our communities. Tonight's guest is Russ Campbell, a real estate investor with a diversified portfolio. Russ will be sharing his strategy on how and why it's necessary to diversify your portfolio among different property types and locations. He will also give us some tips on financing as well as advice for those investors that are just starting out. Stay with us and we'll be right back. Welcome to TMG Tonight. My guest tonight is Russ Campbell, and Russ and his brother Doug have a real estate development company called CRG Inc., and they have been investing in our local real estate since 2005. Their most recent projects are in Southeast Portland, specifically Sellwood area. And they have a beautiful building called Galaxy at Sellwood, 79 units, residential units, and commercial on the ground floor. Russ is here tonight to share his real estate journey, how he got started, and also his perspective for the market to come in the future. So please join me in welcoming Russ Campbell. Hello, Russ.
Hey, how's it going?
Good, good.
See ya.
You too. Well, we can't shake hands.
Okay,
We're 6 feet apart.
Pretty close. Yeah, we're good.
So thank you for being on our show tonight.
Thanks for having me.
So let's start a little bit with telling us, give us a sense of your background and then how you got into real estate investing.
I actually bought something in college. I bought an apartment building in college, a small apartment building. Owned it for about 2 or 3 years, fixed it up, lived in it with a bunch of college roommates. So that's kind of my first start.
Wow.
That was kind of fun, good experience. Learned a lot about how to deal with tenants and tenants that move out and leave a big mess, things like that.
Right.
So started there, left there after college, worked for a real estate development company in Maryland for about 5 years. And then moved west with my family. And after that, got into mortgage finance and was in a career of mortgage finance for about 15 years, but during that time dabbled on the side in some residential land development. So my brother and I started a project in Bend, Oregon. We did a 42 unit subdivision there, partnered with a builder and built that out. That went okay. We had some problems with our builder. And then after that, we started developing in Vancouver area. And from there, we started getting into less land development and home building and started buying apartments. So during the financial crisis, we picked up some REO properties, and that's how we met you guys. You guys
Right.
were managing one of the projects we picked up through a bank sale. And we went from there and bought a few others. And then we left buying distressed real estate and started developing apartments in Portland, in the urban market of Portland.
Well, that's a broad
so that's
experience.
a quick
that is a broad
overview.
experience, though.
Yeah.
So what prompted you in your college days to even think, though, about buying an apartment community? That's pretty young, right? How old were you?
I was
21.
I was 20. Yeah, it was just kind of entrepreneurial experience. I don't know. Just got into it. Wanted to do something. Wanted to own something, and found this property, and my dad helped me finance it. But I managed it all, and we split the profits. It was good. He made money. He was
well,
excited.
That was good.
Yeah, he was excited. It was a good. We did really well actually in 2 years. So, and then from there, working for the development company in Maryland, just was there for about 5 years. Learned a lot about commercial development, residential land development. I was more on the accounting finance side, so I've always kind of been more of a numbers guy, less sort of in the trenches engineering, on the site
Right,
side.
right. Was your brother part of all that back in the day
no,
too, or
Doug,
just you? Okay.
Doug got a master's in land planning and went more consulting work. So he worked for a lot of different consultants right out of school doing regional land planning. Worked for the Puget Sound Regional Council for years, and then in Portland worked for a couple different consultants.
Right.
So he kind of learned more of the dealing with the entitlement side of things, dealing with the cities
the
and the
municipalities,
counties. Yeah, and
yes.
so he was really good at taking a sheet of paper and figuring out the number of lots and measuring it all out and kind of optimizing for the land development side.
Right. That's a good partnership, because especially if you're doing land development, right? So you've done the land development from the subdivision perspective all the way up to the new builds for multifamily.
Yeah.
And so from your accounting standpoint and your finance standpoint,
that's the stuff I love. I mean, I love the finance side, so that's kind of where I can add value to our partnership in a sense. So I kind of handle all the accounting and finance, but. Typically on the finance side, we've been using HUD loans. What we try to do is just a philosophy is to try to match the debt term with the asset term.
Right.
It's kind of a philosophy, and I learned that from a friend of mine. So, so when we're buying property, we try to go longer term on the loans, and so we use HUD loans. HUD loans go pretty far out.
They do.
They're typically 35 or 42 if you're doing a construction. HUD loans are complicated, expensive. Once you've done one, though, you've kind of gone through the ringer, and you kind of know how to do it. And if you've got good underwriters and good brokers, they kind of hold your hand through the process.
Right. So how do you choose a lender for something like that? Because there's a lot of brokers or lenders out there that are doing HUD loans.
Yeah.
How do you choose the right one? Because choosing the right one can make your process much smoother or much more difficult.
Yeah, I mean, it's definitely tricky. I found a loan broker here in Vancouver that was recommended by a friend of mine in Portland that had used them on all their HUD loans. So we used them for the first purchase we did with you guys, Covington. And it worked out great. They were good, but I found we've used another firm lately, Berkadia. They've done a great job. You do have to do your research on that because there are definitely some HUD brokers that are, I would just say, not as transparent on a lot of things, and you want to kind of manage that. There's different things that can happen with your loan rate when you lock it in that you need to be aware of.
Well, rates are the lowest they've been in my entire real estate career.
Yeah.
I'm thinking probably yours too.
Oh yeah, we just refinanced 2 projects. We're the lowest I've ever seen, 285. It's kind of crazy. And that's all I've really done this year. I've done 3 loan refinances.
Right.
So that's been a huge win. I mean, granted, vacancies are up, delinquencies are up because of COVID, but the rate drop has been huge. So that's helped mitigate some of that damage, which has been good.
So when you're out looking for a project, right? You and I just talked earlier about you have a 1031, you're trying to place some funds. Yeah. So how do you go about finding a real estate opportunity, and when you do, and you look at it, how do you evaluate it? Are there some things, a couple factors that are deal breakers on any particular property, or how do you assess that?
Yeah, we're pretty nimble and we'll look at everything and anything, which is maybe sometimes hurts us, but typically location. Try to understand and look for properties where I've got 3 daughters and a son, so they're all millennials, all sort of in that age group that are renting or buying a home now. So I talk to them a lot, kind of learn, okay, where do you like to live? Mm-hmm. Why do you like that apartment? Why do you like that area? What are you looking for?
Built-in research.
Yeah, I mean, one of my daughters, she doesn't drive, so she's, for her, being close to the bus line or being close to light rail or being close to a grocery store is critical for her.
Right.
So she has epilepsy, so it's nice that she can, be close to something. So you try to look for properties that kind of have that element where services are close by.
Right.
Look at surrounding properties around it. How are they being managed? That's important. Let's see.
What about
else?
the number of units? Sometimes, if you're talking about, whether something's 20 units or 80 units, once you get, a larger number of units, you end up having site management. You have to factor those costs in.
Yeah.
So do you try to stay either above or below a certain number, or
kind
how
of try
are
to
you?
stay above 20. I think it depends a lot on who you are as an investor. So if you're starting out right away, the first thing I bought was a 4-unit. I could manage that myself. It's easy, it's manageable. I had the funding for it. So I think if you're entry level, small investor getting into it, obviously you're going to go with smaller projects. But if you can afford to and you've got enough capital, I would go larger projects. I'd stay above 20 units just because it's more cost effective for your time and energy.
Right.
I think even on the bigger urban projects, I'd probably want to stay above 75 units, probably. We've done 2 projects in Southeast that have been 65 to 79, so you kind of want to be around that size.
Right.
So that you kind of have on-site management. I think that works great. When you get on-site maintenance in there and then on-site property management, you got both of them, gets a little tricky with a 50 to 75 unit building. That doesn't quite pencil, so I would say even larger, even 100 units is good if you can make it work. So kind of depends on your investment kind of philosophy and the amount of capital you have too.
Well, what about commercial too? You have the commercial on the ground floor at Galaxy at Sellwood.
Yeah.
And so your experience, you have such a broad experience. So what about commercial? Have you looked at some other commercial projects? And what do you think about the the COVID, now everybody's working remotely, right? So the whole office and retail scenario?
Yeah, I think it's, that's going to be interesting, precarious. I mean, I'm glad I'm not in office and retail right now. I've got a little bit of retail and we're hanging in there, but we've got, a few tenants that are struggling. I've been wanting to get into more kind of small commercial retail in urban areas. Haven't really found anything. I've got a good friend that's got a whole bunch of that. He's getting through COVID okay, but it hasn't been pretty either. I would avoid urban office in the next 3 to 5 years probably, at least downtown Portland. I'd probably avoid that right now. There might be some great opportunities here in a year or two to pick stuff up inexpensively, but we're not running after that. We did, in our Sellwood area, we did sell one of our buildings and we diversified into a warehouse over in Bend. It just felt like Sellwood was getting overbuilt, a lot of it was going up.
And there's a lot more to go up there too, I see on the
And
on the
so
books.
I think one of our philosophies is try to diversify. So if you can diversify within your product types, have a couple different product types, and then also diversify sort of maybe geographically too is important. That's something we're looking at. We're trying to get maybe out of the Portland metro area and maybe look for some stuff in Boise or anywhere outside of Portland.
Right.
Just because we've got a lot of investment now in this area and it's probably good to diversify too. I mean, in terms of product type, we've bought some townhouses with you guys. I mean, we took that one project over, we got another townhouse project. We've been looking for more townhouses. I mean, I would love to find more townhouses. I think
they rent great, don't they?
Yeah,
they
do.
And
I don't want to share my secret sauce with everybody in the world out here, but I'll give you one tip. I mean, I just feel like demographically, there's going to be this millennial wave that is going to want to get out of apartments. They're going to want to get into more of a single families type structure as they get older, get married, start a family. Some of them are not going to be able to afford to buy a house right away.
Right.
If they can rent a 1,500 square foot townhome and have a garage and a place to park the car and have a place to store all their crap.
A little yard.
Yep. So I do think there's a real opportunity there still. So we're looking for more projects like that, but it's been hard to kind of locate stuff right now.
Well, the demand for single-family houses for renters is accelerating also because you're right, they're coming out of the 480 square foot high rent and they're able to rent 1,200 feet or 1,500 feet and they working remotely, so they need a place.
Need more room, need their office.
Exactly. And so, we have some clients that are actually actively out there trying to, buy groups of single-family houses. But the prices are high, right? And they're betting on it's going to keep accelerating.
Yeah, it's tough to make that pencil. I mean, we kind of, we try to look at buying stuff at a, 5 to 6 cap rate. I think buying a new home and renting it out, I just don't think rents have gotten there yet. And at some point, it does become a median income factor. It's just that the affordability to be able to rent something for $2,800 a month is not there, and it's kind of what you need to support a $400,000 house at the end of the day with taxes and insurance and everything. So, I do, and that's one of the reasons why I think the townhome or the smaller skinny homes kind of can fit that envelope a little bit. So I mean, to what they're doing, I think it's about making sure you're buying the right product type within that, not buying maybe a suburban house that's got land and it's a little bit too big. So I mean, they got to buy something that's inexpensive that fits that, because at some point that renter is not going to be able to afford that.
We're going to go to a quick commercial break, and we'll continue our discussion with Russ Campbell.
Really? 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 Hi. Yeah.
Homeworks. Installs, repairs, routine improvement. We keep your home working.
Welcome back. We are here talking with Russ Campbell about real estate investments. And to follow up on our prior conversation, Russ, we talked about investment strategies. So my experience 20 years ago, I don't know that I had an investment strategy. I came across a couple opportunities and I just took them. So what about you?
Yeah, I think ours has been very sort of entrepreneurial, kind of fly by the seat of our pants to a certain extent initially. Kind of looked at everything and didn't really necessarily have an investment strategy at first. I think as time went on, we sort of focused on residential land development just because we sort of knew it. So as we got better at understanding and underwriting and learning the business, I guess we got more focusing on that one area. But at first, I don't think we necessarily had any sort of grand strategy of we're only going to go after this sort of product type. But like a good example, now we've owned a bunch of townhomes. We kind of like those. We know it. We can underwrite it easier. So I guess now that would be a strategy we are focusing on to try to find more of those. So it kind of evolves. But yeah, it was sort of, initially it was sort of like, go after everything and see what fits. Usually, for me, it's always been the underwriting part. As long as I can underwrite it and I can look at the cash flows and I can evaluate the cash flows and understand the risk of those cash flow estimates, and I feel comfortable with that, with the analysis that I've done and the research I've done and help from you guys, that makes me more comfortable to follow through with buying the asset.
So let's talk about the underwriting and the evaluating, of a property. How do you go about doing that specifically?
Yeah, I think it's first identifying a good team. So if you're working with a broker or a broker brought you something, try to utilize their expertise on the market, understanding the property, the surrounding properties, what properties are selling for. Bring in TMG to help evaluate income and expenses. That's critical. I mean, on every deal we look at, even on a new development deal, if you guys are going to manage it, I want you to be able to underwrite what you think the expenses are and the revenue. I have a pretty good idea now because we've bought enough and owned enough that I can figure a lot of that stuff out too. But having a third-party reviewer that's in the trenches, especially if it's kind of a new product type, is important. So having a good property manager, having a good broker, the lending side's critical, making sure you have a good lender that you trust that can help evaluate the project early on, so that if you are doing a Fannie Freddie loan or you're doing a credit union, bank financing, I try to get in front of that lender right away with a package, underwrite this, make sure that I find out what the terms of the rate will be, the terms of the loan, so I can have that in my model, and that I'm comfortable I can close with them, that they'll close. So you kind of got to do all three of those, because it's kind of like three pegs on a stool. If one of those breaks, your deal's not going to work. So if you can't get the financing, the lender backs out, not going to work. If the property manager isn't there to evaluate your revenue and expenses, you're going to miss it on your model and you're going to blow up. You're going to pay too much for the building.
Right.
So,
well, have you ever overanalyzed a property, like 101 ways something's going to go sideways, and you get caught up in all that? Has that happened to you?
a little bit. I mean, yeah. I mean, I've got a certain way that I underwrite it and model it, and once the cash flow model's built, it's done. I think you can. I stress test it, so I've tried to figure out, okay, worst case, rents don't grow, and you guys are off on your revenue. My expenses are higher, so I do a worst case. Okay, how much money am I going to lose, or what's the return on investment under my worst case scenario? What's it under my base case, and what's it under my best case? As long as I can live with the worst case, and I'm not going to have to give it back to the bank, or go under or something, then that's good.
Right.
If I'm running a worst case, and I'm going to get hammered, then I might not do the project.
Right.
So that's why I think it's important to diversify too. I think one of our strategies on investment, and we've invested in some other projects under some funds, and we've tried to only invest a certain amount of capital in a bunch of different spots. So if you've got some capital to invest, don't put it all in one building. You got to kind of divide it up and spread it out, even if you're ended up buying some smaller projects, because you're going to make a mistake. We haven't made one yet, but you could. So
well, the market's ever changing too, and by the time when you actually find an opportunity to when you close, you actually close escrow, could be a significant amount of time.
Yeah,
and
that's true.
Depending on things like COVID happen, and there's transactions that are happening right now that are in escrow. They've been in escrow since COVID started, and they're having an issue closing because perhaps delinquencies or other issues.
Yeah,
so.
I mean, I think COVID is a real wake-up call in this sort of modern era that we're in the last 30 or 40 years, 50 years. I mean, the financial crisis in 08, 09 was too, to a certain extent, but nobody thought that would be a risk, that a small commercial retail building on Hawthorne or something would have problems because they've got 3 tenants that are all impacted by COVID and they're all going under.
Right.
Who would have ever thought that?
Right. All at the same time, and right.
And who would have thought that a $50 million office building in downtown Portland is empty right now,
Right.
and all the tenants are calling up to renegotiate their leases, and a lot of them are moving out to the suburbs.
They are.
Because they want to get out of downtown Portland. That building was worth $50 million. Now it's going to be worth $30 million.
And
it's got
dropping
debt,
depending
and it's got debt of 40.
Right.
And so,
Right.
if you put all your equity into that with a bunch of people, guess what? It's gone to zero. So that's why you got to diversify. Don't put all your eggs in one basket, and you probably need to diversify geographically too, which we haven't done a lot of. So I think that's important too, which is harder because you got to travel to another area, stuff like that. But I mean, having a good property manager can help with that. So especially like if you guys expand, that would help me. So you should open an office in Boise.
We're thinking about it. We're actually opening an office in Tri-Cities too. Okay. That's kind of a good area.
Good.
So yeah,
townhouses in Tri-Cities.
Yeah,
that's
there
good.
you go.
Okay.
So was there a turning point as you moved through your real estate investing career? Was there a turning point when you said, "Wow, I got this. I know I'm going to be successful"? It was an aha moment that I got it. I know my stuff now.
I think more because of my finance accounting background. When I build a model and I have all my assumptions in there, and then I go back 2 or 3 years from now, 2 or 3 years after I bought it, and I compare it to my model, and I see that, okay, I hit all my numbers, that means I underwrote it. And I feel good about that. And that's happened on most of our projects. We were conservative in our underwriting, maybe too conservative because we lost some deals. But I mean, I feel good because I've done enough projects and we've modeled it out, and I haven't been overly aggressive. A lot of people will model, they want to buy it, and so they'll change the assumptions to make it so they'll buy it.
To make it to fit.
To fit.
Yes, when it doesn't really, yes.
That's just, you're going to screw yourself. So, anyway.
Right. So predictions, your perspective potentially after COVID. So they're talking about being able, that we would be past, there'd be a vaccine, we'd be past some of this with COVID by the second quarter of 2021. Yeah. And they're all talking about the U recovery, the V recovery, the W recovery, the straight up recovery. Yeah. So what do you think is going to happen in 2021?
I think it's a big, wide U, probably. And the bottom part of that U might be a year and a half, 2 years. I mean, I do think there's going to be a lot of smaller restaurants that aren't going to come back, and even some of the larger restaurants, because they've had such a capital investment, they're over-levered. A lot of those restaurants probably weren't good business models anyway.
Right.
They weren't probably making very much money.
Margins are slim.
Margins were slim, and they were just hanging on. So at the end of the day, there's going to be fewer restaurants going forward. But maybe there were too many anyway. I don't like to say that, but so I think there'll be more vacancies, commercial vacancies, because of that. I think we're all pretty resilient though, so I think we all want to get back to a normalcy. So I think we'll get back there, but it's going to take 2 or 3 years.
Right. Yes.
Yeah, and I do think if you want to travel, I'd start booking your travel in like a year or 6 months from now, because when this is over, you're not going to be able to go anywhere because everybody else is going to want to go somewhere.
Exactly.
So anyway, I'm just thinking, God, if I'm trying to go somewhere in a year and a half, how am I going to book something? Everything's going to be booked. So.
Well, talking about the restaurant industry and hospitality and all of that, there's a lot of tenants that work in those industries, and so I wonder how that's going to look, for the rental market.
Yeah.
Just the residential rental market. They're going to have to find other professions. There isn't going to be near the restaurants or hospitality that there has been.
No, I think we're going to have some structural unemployment that's going to be around for a while. And I think the government's going to have to help, figure out a way to step in to help retrain people, or, I don't know. Somehow that's got to hopefully fix itself over time, just like after 2008 and 9.
Right.
But, a lot of those manufacturing jobs never came back, and the same thing's going to happen here. A lot of those restaurant jobs aren't going to come back, so you're going to have more entry-level service jobs, maybe in the medical field or light manufacturing or something, but a lot of those people are going to have to probably find something else to do.
Yeah.
I mean, we do, not to get into politics, but because of the reduced immigration that's happened, you do have a lot, fewer people maybe in some of those entry-level jobs that are immigrating in the United States. So, there's fewer people that take those jobs, so maybe some of the people that are out of the restaurant hospitality jobs
We'll go
are
into
going
that.
to some of those other jobs.
Right.
So
So you were in real estate, investing in real estate in the Great Recession, right, 2008 or so, and so so do you think there's going to be opportunities? Going forward, 2021, 2022, to capture some of those other properties like there were in 2008 or 2009?
I think that was more of a financial crisis. This is more of a demand crisis. Not that I'm an economist, but I kind of feel like that was more of a financial liquidity crisis. And so there was a lot of over leverage then. I mean, there's over leverage now too, but not as much. So I don't think you'll have as much distressed properties probably. And I think banks, because of COVID, a lot of them are being forced to work out with their lendees. So I think there'll be more workouts at the bank level, and because there's less leverage, I don't think you'll have a lot, but you'll have some distressed properties.
Right.
I think you probably will on the hospitality side, because some of those hotels that have been built in the last 4 or 5 years in sub-markets that weren't that strong, those will probably go under, I'm afraid. So.
Well, I was just reading an article Forbes had about wins in Las Vegas that, first time in history that, they're only going to have people be at their hotel between Thursday and Monday. And so like a 4-day deal. So, and other hotels, I guess, are starting to follow. So you have a huge industry, gambling, hotels, entertainment, all of that, the hundreds of thousands of people that work in that industry, and it's not just Las Vegas, it will be others.
Now temporary workers instead of full time.
Yes, and so the sheer impact, the taxes won't be there for the municipalities. I mean, it's a full range of issues that's going to cause.
I mean, I think again we will get back to some normalcy, and that program I think probably makes sense now because the demand's not there. So. But I think the demand will come back. So the question is, are they talking about permanently doing that? Once there's demand, people want to go there.
Right. They said that there's just so little demand that they just couldn't afford to keep it operating the other 3 days of the week. So.
Yeah. I think that makes sense now, and I understand that. I think once we get through this in a year and a half, that'll change over time, and I think it'll change pretty fast because people are going to come out of the woodwork and they're going to want to go to Vegas, go to Disneyland.
Right. Everybody's been cooped up for 6 months?
I mean, you look at all the people that are camping and on the road now. I mean, you got a flood of people that are, doing that because they can't travel outside of the country or can't fly, so they're all staying local. And I have heard like Sun River, I think, had record occupancy this summer, and they were packed.
Right.
Because everybody stayed local. So there are some areas in the economy that are doing much better. Zoom's doing great.
They are.
So,
Stock market.
anyway, yeah,
Stock market's been
doing
doing
great,
pretty well.
But that's more liquidity based. I
Right.
mean, the Fed's pumping all kinds of money into it, so
Right.
it's kind of funny money, I think, a little bit.
Right.
So anyway.
Well, good. Well, I think we'll close by the funny money comment.
Okay, funny money, yeah.
Thank you so much for being on
Yeah,
TMG
great.
tonight.
It's great
and
being here. Yeah,
all
thank
of
you.
all of our viewers, take heart to Russ's advice about how he started out. You're never too young.
That's right.
Thank you again.